All
So
right.
before I forget, let me turn on the recording because I always forget. Come on. There it is. So now we are live and recording, and it is 6 p.m. on a Tuesday, which means at least where I am. So it's time for our Tax Sherpa show. Tax Sherpa Live. Today is June what? June 11th. We actually had our monthly navigator call earlier today, went over a bunch of details on, actually, it wasn't as much detail as it was a more big picture about how the different tax strategies work together, how we put kids on payroll, how we integrate profit first, how we can layer in additional things as people make more money, as their business is more successful, because you will be if you actually focus on your business. That's the thing. Um, part of our part of our meetings template is to actually get people to run their business and operate it like professional management. And the difficult thing with small business is that it is small. So, most people go into business because they're really good at something. They've spent years doing whatever it is, and they say, actually, I can do this for myself. And they do, and they mostly do okay. Um, the Where they get stuck, or maybe not stuck is the right word, where they're not as effective as they could be, is that operational level where you're looking at, your books on a monthly basis, on a quarterly basis, on an annual basis, and you're actually paying attention to cash flows um, and money transfers and accounts receivable and accounts payable and all that kind of stuff. Um, which most people just don't take the time to do. They're just too busy doing the thing on the day to day, which is understandable, but you got to do it. That's why every publicly listed company has quarterly meetings. And, they're one, they're required by law, but two, they would do it anyway because you got to review stuff. You got to see what's going on. And if you're a small business person, a solopreneur, or maybe you have a couple people on working for you, whether it's contractors or employees, you know, you just have to take that time. And if we're going to take that time to make your business run better, let's also take tax advantages when we can. So we get a two for one. But anywho, that's actually not what we're talking about today. Today we're doing some Q&A kind of stuff. Let me share my screen. Office hours. There it is. So we are office hours Q&A as we do. Here's my story, the quickie version. I went from owing $1.3 million to nothing. And in doing so, I fixed my own tax problems and learned the world of Wall Street tax planning. So, over the years, done 50,000 plus tax returns, billions of dollars worth of client revenue, and you know, back in 2019, but really in 2020, launched Tax Sherpa because, like I was just saying, it was years of experience doing a thing, went off on my own, to one, do it for myself, but also to target my tribe. And that tribe is those small business solopreneur types, the people who either can't or won't get a job because this is not in your personality makeup. And the goal is to get your life back, get your quality of life back because when we save on taxes, well, I guess let's do this in the right order. The quality of our questions determines the quality of our life. I love this quote. I read it every week. It's true every week. And so my question becomes, what is the problem with overpaying on your taxes? Because you can. I mean, there's nothing illegal about overpaying on your taxes. Um, the real problem, though, is that you are wasting 20% of your life. So, 20%, because if you go to work and you work all day doing whatever it is you do, you bring in revenue, you have expenses, the net is what you have left over, and then you have to take that money from that day and hand it over to the government. Who are you really working for? You know, you're working for the government for those days. And what we find is that most small business people, most solopreneurs, are wasting 74 days of their lives each and every year, which is mind-boggling. I mean, it's 2.5 months. because you're overpaying on your taxes by not being structured properly, by not taking advantage of tax planning opportunities given your particular situation. And that's kind of the whole thing with tax planning is that everybody's facts and circumstances are different. Um, and so whenever people ask tax questions, we always have the answer. It depends. So what does it depend on is always the next question. It's like, well, it depends on what you have going on in your particular tax life. Are you making a W-2 from a day job? Earlier today on the monthly navigator call, I was talking about how, a lot of times if somebody wants to build a real estate portfolio, you're limited on passive losses, either because your income's too high or whatever. But to change that into active, a lot of times we can get a spouse in
Mm.
order to qualify as an active real estate participant. And once you go active, then the passive limitations go away because it's now active and not passive. So, those are the kinds of things we start to talk about when we say it depends, because what's true for you is not going to be true for somebody else. And there's a million different versions of that. I'm trying to think of a the one that always comes to mind is a little bit R-rated, so we're not going to go into that. But the you know, there's a concept in tax of, necessary and ordinary expenses. So what is necessary and ordinary for one type of business is not necessarily going to be necessary and ordinary for another type of business. So uh, let's say you bought a boat and you say, "Can I deduct this?" You say, "Well, depends. Is there a business use for that boat? If your business is, I don't know, you know, landscaping, and you cut grass and trim hedges and plant gardens and stuff, gonna be hard to justify a boat. But if you are, a sea captain, then yeah, that's a business expense, or it's a business asset anyway. So it's just an example of how it depends. Same exact boat. It's deductible for one person, not deductible for another, because there has to be a business use that is necessary and ordinary for that kind of business. Talked to one guy, speaking of boats, he's in the marketing business and he does ads and lead gen and that kind of thing. And he was actually able to demonstrate that his by putting his boat in his advertising, it's kind of like aspirational, you can be a millionaire too kind of thing. Um, his his cost per thousand ads actually went down. And so that was a very, very good justification for it being a business purpose for at least that portion. So yeah, it just depends. Uh, so so Serena, what do we have on deck, and what am I going to tell you that it depends too?
Right, right, right. So we have four different categories we're going to talk about.
Okay.
Tax planning, the A31B,
Uh-huh.
cost segs, and the 179 process.
179 process. Okay.
Alrighty.
What do you
So,
want to do first?
alrighty. So we're going to go into the tax planning
Okay.
process. Okay. So we have a client that wants to know about the key components of an effective tax plan. What are
That's
they?
that's an interesting question. So, you know, we break it into four stages. So the first stage is the survey. So the survey is figuring out where you are now, getting a lay of the land. What kind of income do you have? What kind of expenses do you have? What kind of assets do you have? What kind of investments do you have? What kind of family situation do you have? Do you have kids? Are you divorced? Do you swap your kids back and forth each year? All these kind of things go into it as far as figuring out where you are now. And then the second stage is the route. It's like, so we say, okay, we've surveyed your situation. Now, given those pieces and your goals, how do we get from point A to point B? Um, so that's actually where a lot of the questions come in, because there we're identifying different strategies that's going to apply to that particular client situation. And the number, there's like thousands of tax strategies, when you break it into their individual components, because, there's federal, then there's states, and then there's, different rules for different pieces and all this kind of stuff. So the question is what applies to you in your situation. Maybe you have R&D expenses in your business. Maybe you could do something, just pick an example. Um, we see a lot of people come in with a tax return and they have their 1040, and on the 1040 is a Schedule C. And on the Schedule C is an LLC. So LLCs are these very weird things when it comes to taxes because for federal purposes, they do not exist. The IRS calls them a creature of the state. And uh, so as a result of that is that an LLC can be taxed in a number of different ways. It could be a Schedule C, it could be a Schedule E, it could be an 1120, 1120S, a 1065. And so you have to tell the IRS how you want it to be treated. Or there are default options. If you don't tell them, they'll say, okay, it's going to be this way unless you tell us otherwise. But you know, so we have this tool in the form of an LLC, and then the question becomes, okay, what can we do with this? Should we elect S corps? Should we elect a partnership status? Should we elect a C corp status? And it's going to depend. Um, so one client in particular that I'm thinking of, he's got a C corp uh, and a 1065. So he's got 1120 and a 1065 in addition to his 1040. And the reason for that is because he is trying to uh, use the 1202 strategy. So 1202 is a code section related to founder stock. So here's a big incentive for anybody who wants to uh, play the Wall Street game. So if you are a founder of a C corporation and you hold that C corporation for at least 5 years, and then you sell those shares, you can exclude up to $10 million worth of profits because, it's founder stock, so you have no cost. Um, you can exclude up to $10 million worth of profit from your taxes tax free. And this has been there's been a couple different pieces of legislation that created this. It used to be like 50% up to 10 million, but as from 2009, I think it was, they changed it to 100% up to 10 million. So the first 10 million of founder stock that you sell as a stock sale for a C corp becomes tax free under Section 1202, which is great. Um, the problem with it is that at those levels, very rarely do the buyers actually want your stock because because the when you buy a company and you're buying the whole company, then you are also buying whatever potential problems it might have had in the past because you are now the owner of the whole company and the company itself didn't change. So what most people do is they do an asset sale where one buyer comes in and buys the assets of the old business. Now, an asset sale does not qualify for 1202 stock because you're not selling the stock. You're just selling, usually goodwill and lists and, maybe some intellectual property and stuff like that. Um, so, there's negotiations to be had at that point. Anywho, um, this particular client is, we've made him aware of all these issues when it comes to the small size M&A market and that's mergers and acquisitions. And he says, "Yeah, well, I'm going to try it." So, okay. So, so we set him up strategies related to that. And so when it comes to what are the elements of a good plan? Well, actually, sorry, that's just step number two, or phase two. Phase three is the route. So survey, figure out where you are. Um, or sorry, phase two is route, figuring out how to get from point A to point B. Phase three is trek. So you got to actually make the trek. You got to do the work. You got to implement the tax strategies. And then phase four is the compass check. So as you're going through your trek, you got to check to see, are we still on track? Our projections where we thought they were going to be as the year evolves, as the years evolve, obviously things are going to change. It's like, oh, business is up, business is down. Oh, I got married, I got divorced, I had a kid, all kinds of things happen. So, we gotta adjust as we go so that we stay on track for our goal destination of minimizing your tax burden as much as possible. So those four phases are all the key components that go into tax planning. Um, when you want to get more granular than that, it's like we get back to it depends because it just depends on what you have going on. Um, I will tell you that most of the time, small business people, solopreneurs, that kind of thing, most of the time, S corp is going to be the way to go as far as entity structuring. Sometimes we'll also need another entity, like a 1065, but that's like 20% of the time. Um, you know, we have our what we call our workhorse strategies in that, they're used pretty much with every business, reimbursement plans, medical reimbursements, office reimbursements, those kind of things, meeting strategies, all that kind of stuff is kind of we use a lot just because they apply to every business. So that makes sense. And so but to get, into the details is, it's too general of a question. We would have to look at each individual client's situation in their survey and then assess what's appropriate at that point. So I hope that covers it, but I know it's kind of a general, general, it depends.
Right, right. So the next topic is Section 179 deduction.
Mm,
We have a client that asks, what type of properties qualify for the Section 179 deduction?
a lot. Um, uh, Basically, just about every kind of property except for real property. So Section 179 is a way to deduct the entirety of a business asset. So um, if you have, let's say you bought a computer, right? You bought a high-end computer. I bought one a couple like a month ago, for I don't know, it's like $1,800. So computers are 5-year property, meaning that you would distribute the purchase of that over 5 years, and you take 20% each year. You know, up rounding, but that's the idea. There's calendar year issues if you buy it not on January 1st, but with that said, 20% a year, just to give you a rough idea. So if it's a $2,000 computer, that'd be $400 a year. That's the usual rule. That's the standard rule. However, there's all kinds of modifications to the standard rule that can apply. So Section 179 is one of those modifications. In Section 179, you are permitted to deduct the entire amount, so that full $2,000 in year one. The caveat, though, is that you are limited to profit. So what that means is that if your business has let's say the business has a net operating profit of $20,000, and then, that's with the normal 20% depreciation. Then in the 20, there's enough room to take out two and deduct that. So if the company was running at a net loss, like negative 20, then you could not use Section 179 because Section 179 only applies if there's enough profit to absorb that deduction. Um, Now, with that said, there are limitations there are special asset categories. Cars are the big one. People always want to deduct their $70,000 car and use Section 179 because it's over 6,000 pounds. And yeah, okay, you can do it. The You have to be careful when it comes to cars. You have to be careful in assessing business usage versus personal usage, because it is, the thing with all like tax strategies and deductions and everything is that, they all get abused. So that's what tax court cases are, right? A tax court case, if you look through the history, it's almost all lawyers and it's almost all tax professionals themselves, because they're the ones who are willing to fight in tax court against the IRS. And by the time things get to tax court, the IRS usually wins. Um, but you know, when you read the court opinions, it'll have like an intro section. And it'll say John Smith, comma, a lawyer from Texas, comma, and something something, or John Smith, comma, a tax preparer from Mississippi, and it's always like one of those two things because they're always the ones who like to push and push and push. Um, so that's just a random aside. But so when it comes to cars specifically, you want to actually be clear about, what is business, what is personal, because So like, I've had clients in the past who ran security companies. So like they would be the neighborhood patrol people uh for HOA neighborhoods or for retail stores like jewelers and that kind of thing. And so their cars were used by their employees and they were wrapped in their graphics and 100% business cars. So we're able to claim the entire amount of the purchase. Uh, but if you have I don't know, let's say you're that landscaping person I talked about earlier. You have a truck and you use the truck for work and you go around to clients' properties and you cut grass and trim hedges and whatever. But you also use that truck for your personal life. Then you have to separate those two things and you have to track. It's like, okay, I spent, 82% of my miles on business and 18% on personal. And, you want to have the documentation to back all that up. Because, when it comes into these larger price assets, those things become more of a write-off and then become more important. I've seen such crazy stuff on car things, and so has the IRS. So that's why those things get scrutinized more. Um, so with all that said, that has to be done regardless, whether you're doing 179, whether you're doing regular depreciation, or whether you're doing bonus depreciation. So bonus depreciation is another modification to the regular depreciation rules, and it changes depending on current legislation. So right now, we are in the Tax Cut and Jobs Act regime. So up until last year, or up until the end of 2022, rather, bonus depreciation allowed for 100% write-off, same as 179, but you did not have the restriction of having to have net profit. So even if you had a loss, you were still able to deduct that full $2,000 for that computer under bonus depreciation rules. Now, in 2023, that 100% first year write-off got shrunk to 80%. In 2024, it's getting shrunk to 60%. And we'll see how it all shakes out because the issue with these, you know, they used to call it voodoo economics, where you would have these sunrises and sunsets on different code for how things are treated. That's what they called it in the 90s was voodoo economics. And um, we are in the tail phase of the Tax Cut and Jobs Act, which was Trump's tax reform, because it was a 10-year plan. So it's 2017, it's going through 2026. And so these provisions are starting to expire, and they had to do it that way because when they passed the law originally, every piece of legislation gets scored by the Congressional Budget Office, and they had to get it to be some revenue target in order to, pass muster for legislation. And so there are all these weird things that are happening now, um, like the step down in bonus depreciation. I think in 2026 it'll be 50%. I'm not 100% sure about that. I have to read up on it. It's been so long since we had to review those. But there was legislation in Congress this January that was going to reverse all that and was going to extend the 100% depreciation, do it retroactively for 2023, and continue it until 2026. And the House passed it, and then it got stuck in the Senate, and it just sat there. Even though the Senate's, released public relations things saying, "Hey, yeah, we have this bill, we're going to pass it, blah blah blah," for whatever political reason, it just never got through. And so it's just been sitting there in the Senate waiting for something. And but so this kind of stuff happens all the time with these like random tax provisions where it's like you know some years uh some years mortgage insurance will be deductible, some years it won't. Some years we'll get it during 2020 we got a below the line charitable deduction of $300. So normally your charitable contribution is included in your Schedule A of your itemized deductions. So that's like medical stuff, local taxes, mortgage interest, charity, and then a couple other random things at the bottom. And then in that year in particular, they said, okay, well, you can deduct up to $300 uh, for charitable contributions outside of your itemized deductions. So if your standard deduction was 12,000, you could put in another 300 for charity, and it was just a separate line item. And that's just, people ask a lot of times, it's like, well, why is it this way? Why is it that way? It's just because that's what Congress said, you know. It's just it's all political, you know, machinations. Um, so so when it comes to bonus depreciation versus Section 179, like 2011, bonus depreciation was better. 2012, 179 was better. 2017 through now, bonus depreciation has been better, but now we might be tipping back the other way, where Section 179 is might be more appropriate, given if you have the room in your profit to absorb it. And you know, there's caps of like $2 million or something. I've never come close to hitting the caps on Section 179, but yeah. So fundamentally, pretty much any business asset besides real property, so buildings and things like that, and and yeah, sometimes it's appropriate, sometimes it's not. Oh, you're muted.
Really fast, Neil. Can they carry over unused Section 179 deductions for the future years?
Yes, you can.
Okay. Okay. And then what happens if they exceed the Section 179 deduction limit?
For that given year, just well, like if you hit the zero bound on your profit, it just rolls over. If you hit the global limit, then you know I think I'd have to actually look that up, but I've never seen it actually happen. I think if you hit the global limit, then that remaining basis will just carry forward into the future.
Oh, cool. Alrighty. Well, we're going to move over to the cost segregation reports.
Okay.
So we do have a question. It says the client asks, what type of properties are eligible for the cost segregation studies?
So any investment property, when we're talking about real estate here,
Mhm.
any investment property is eligible to be cost segregated. So what cost segregation is you buy a piece of property. Let's just take a house. You buy a house. Normally, so housing, residential real estate as an investment gets depreciated over 27 and a half years. So roughly 4% a year. But realistically, you didn't actually buy just one thing. You bought a whole mess of stuff. You bought a piece of land, you bought a driveway, you bought a walkway, you bought some landscaping, you bought uh, a residential housing structure, you bought wiring, you bought cabinetry, you bought appliances, you bought flooring, you bought a roof, you know. So all these different things. So what a cost segregation study does is it goes in and it analyzes your property and segregates or separates all those different pieces because each of those different pieces has a different depreciable life. And so what happens is that, you know, if you're able to 179 or to bonus depreciate those shorter lifetime properties, then you're able to take a much bigger deduction in the front year, maybe a year or two, of owning that piece of property as compared to spreading it all out over 27 and a half years. So any investment property can be applied for a cost segregation. The question really is, or the question they should be asking is, does it apply to me? Because again, it depends.
Right, right,
So,
right.
you know, it depends on what else you have going on. It depends on how much income you have. It depends on if you are active or passive. Um, so, you know, you have to look at those kind of things as to because we've seen clients, you know, new clients come in and they say, oh, you know, I did a cost segregation study. It's like, yeah, but why? Because you know, you spent this money to get this study done, and the study's valid, and all these things are true, but you in particular cannot use it because you're not active and you make too much money in order to take passive losses. So it'll just carry forward, you know, until you either make less money, become active, or sell the property. And that's fine, but it's just a waste of money because they didn't ask the question of, you know, will this help me in my particular situation? We had one client who had an interesting case, makes a lot of money, was doing uh, a lot of real estate sales, was, you know, they're realtors. And you know, they were buying property and doing cost segregations and it worked beautifully. And then the real estate market started drying up. So they spent less time on the real estate and they actually dropped out of professional status. Um, Now, as it turns out, some of their properties were active anyways because they were under 7 days, so we could still use those, but other ones couldn't. So it all depends. And, you have to be very mindful of the particulars as far as, will the cost segregation help me? Because, if you ask the people selling the cost segregation reports, they'll say, of course, it'll save you XYZ dollars. Same thing with the people selling solar systems, for your house. It's like, oh, you get a 30% tax credit on your taxes. It's like, yeah, if you have enough tax owed in order to use that credit. If you don't, you lose it. So it's just don't listen to salesmen as if you if
Right.
you are asking them, oh, do I need this thing? It's like, yeah, they're gonna say yes. That's what they do. Um, so you have to know your current situation. That's the survey, and you got to know, is this going to work for you? That's going to be part of your route.
Right. So are there risks involved with doing one of those reports, the cost seg reports?
I mean, as long as you do it with a reputable company, it should be fine. Um, I've never seen an issue with one of the big companies. So these are engineering firms that generate these reports. Now, if you were to say, "Oh, I'm just assuming that, you know, this property is worth this amount and this much is wiring, that much is cabinetry," and you don't have anything to back it up and you're not actually doing the study, then yeah, that could be a problem. That's one of those abuse things rather than use. So, but yeah, I mean, if you go through the proper channels, it's fine. I haven't seen any. I don't think I've ever seen it questioned on an IRS level.
Right. And so how many times can a client do a cost seg report? Is it one time per property or how does that work?
One time per property. You can do as many properties as you want. So, like, if you are, like, I've done this math with people who invest in multifamily, so like small apartments and that kind of stuff, where, they buy a piece of property and then they do a cost segregation study. And, it varies, but, 15%-ish is kind of what we end up identifying, or not we, but the engineering people end up identifying as far as the shorter life property. And Uh, so when you go in and you do that and you take that big depreciation, then you're going to be lowering your tax pretty much by an amount that can be then rolled over into a new property the following year because down payments are going to be 15-20% a lot of times. So if you're saving 20% on each one by doing cost segregation, that frees up cash in order to put down on the next property the next year, and then you do cost segregation on that property. Take that 20%, put it down on the third property, and you can keep doing that for as long as you want. So yeah, you can do it as many times as you want, but one time per property because once you've segregated it, that's kind of it. You've now done that analysis.
Right. So that's why you got to be careful on if you need it or if you don't need it, right?
Yep.
Okay, understood. Alrighty. So we have the next topic, which is the 831B private reinsurance.
Mhm.
So a client wants to know how does that process work and is it beneficial for tax purposes?
It can be. Yeah, so captive insurance or private insurance, whatever you want to call it. This is one of those things that has been abused a lot. And so if you look on the IRS Dirty Dozen list, you'll see this tax strategy. And what it is you have a business. Your business has whatever kind of risk that it cannot go out and buy a regular insurance policy for. So like you can go out and you can buy business liability risk. You can buy E&O insurance. You can buy um, closure insurance. You can buy there's a bunch of different business insurance policies out there available on the general market. But you might have something that you cannot buy insurance for, like reputational damage or uh, people used to talk about supply chain issues, which became very apparent during COVID. So, there's a bunch of them that, realistically, there's no insurance company out there that's going to write you a standard policy for that. So, what Congress did in creating this legislation was they said, okay, you can kind of quasi self-insure, and under the rules for these small insurance companies that you could create, then the premiums become not taxable income, which is just a quirk of insurance companies. So the basic idea of how it works is your business has a risk that it cannot buy insurance for in the open market. So it creates a private insurance company to offset that risk. So the 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 main company is going to pay an insurance premium to to the new insurance company. And there's different variations of how this all works, but I'm just kind of giving you the basics here. Um, so that insurance premium that is paid is just an insurance expense for the operating company, and that's going to lower your overall income, and then that's going to, save you on tax. So that's the main piece right there. The insurance company then takes that money as a premium, and because of special rules under Section 831B, um, that money sits in the insurance company not taxed. And then the insurance company, so what all insurance companies do, your Geico's and your Liberty Mutuals and whatever other insurance company you want to look at, what they do is they take premium in, they invest that money in fairly conservative things, and then they manage their portfolios so that they have enough liquidity to pay out claims should um, should claims arise. And they do an actuarial analysis on every new policy to make sure that they're within the parameters that they need in order to have enough money on hand to pay out claims. Obviously, they don't want to pay claims. If you've ever dealt with an insurance company, you know this. But so you manage your little insurance company in the same kind of way. So, you could hold on to just cash. You could put it in, treasury bills. You could put it into a very conservative kind of, stock and bond portfolio. What you're not going to do is you're not going to take that money and then go do something aggressive with it. You're not going to put it in crypto. You're not going to lend it out for, you know, some guy's rehab loan. You're not going to do any of that. It's just going to be very boring, uh, you know, trustworthy and liquid kind of investments. So the insurance company ends up, with this premium money coming in, and then it has investment income. The investment income, which is the yield on that premium money, is taxable. And so it's a C corporation, so it'll pay, 21% tax. And then, when those insurance policies either expire or get paid out, then the next phase happens. So if they expire and no claim is made, then they don't have to keep hold of that capital anymore. They can distribute it out as dividends, or you can invest it more aggressively, or a couple other different variations. So that's kind of the basic idea. So your business has a risk. You can't buy insurance for it. You create insurance for it, and then you pay an insurance premium for it. And that insurance premium is a business deduction because it's just just like any other insurance premium is. Special exception for life insurance. But yeah, that's the basic idea. Again, there's many like variants on how this is all done as far as the actual structure, and whether you use reinsurance or you self-insure or you pool amongst a couple different people or all kinds of things. But yeah, that's the basic premise. So it can be really really useful. If you have real risk. So uh, you know, I've seen many, many people, clients and friends and otherwise, that I knew in the online business world, and they'll be running along and something happens. A provider decides we don't like you. It could be Google, could be Facebook, could be PayPal, could be all kinds of things. Said, we're just shutting down your account. There's no recourse, there's no explanation, there's no nothing, and it's out of the blue. And then their business collapses. That is a business risk that people in that industry have that they cannot go out and buy insurance for. So it's a perfect case for captive or reinsurance kind of strategies because that stuff happens all the time, and it can be devastating to their businesses when that kind of thing happens.
Okay. Moving from the 831B questions over to just tax questions, other tax
Sure.
questions. A client wants to know, how can I use tax loss harvesting to offset capital gains?
Okay, so tax loss harvesting is a very it's So I'm trying to think of the shortest way to explain this. So you have capital gains. So you've sold stock or something throughout the year and you have a positive gain. So let's say it's $50,000. You bet right on Nvidia, which is the hot stock of this year. So now you're sitting on this $50,000 profit. You're like, well, if that's it, then I'm going to pay, capital gains tax, whether it's long term or short term, on that $50,000. And I don't really want to do that. So I would look at tax loss harvesting. So tax loss harvesting is when you look through your portfolio and you say, well, I made $50,000 on here, and that one I already sold it, it's done. I have these stocks that I still hold that have been losing from when I bought them. So they're in net loss territory. And I'm going to sell those losers in order to absorb as much of that $50,000 as I can. So let's say I have $30,000 worth of losses. So now I have 50,000 gain, I have 30,000 loss that I sell in the same calendar year, and now those get netted out. So now my net gain is 20,000. And so the tax on 20 is less than the tax on 50. And that's the basic idea of tax loss harvesting. Now, that gets into what's called the wash sale. So the the thing that trips people up is like, okay, so I sold these losers, but I think they're going to turn around, and so I don't really want to sell them forever, but I just want to sell them to get the offset from the gains. Like, well, so now the key is there's a wash sale rule that says if you rebuy that same stock or even a substantially similar stock that is within 30 days, then your sale of that loser does not count. So if you sell that $30,000 worth of losses and then you rebuy it 2 weeks later, that 30,000 goes away. And you don't get to use that loss. So if you do end up rebuying, make sure you wait at least 31 days, 33 to be, conservative, because there's a 3-day settlement on although I actually read an article that might be changing. It might be T plus one on New York. But anyway, um, so wait over a month in order to if you want to rebuy those same shares back. Um, So, let's say, you had Tesla and you had Nvidia. Nvidia shot up, Tesla is not doing well. You sold the Tesla to absorb the gain of the Nvidia sale. But you still like Tesla. You still think I've had people tell me Tesla owns the future, whatever that means. And so there are hardcore fans of Tesla out there. And so you still believe in the company long term. You want to buy it back. Just wait at least a month so you avoid any wash sale issues. And um, and then yeah, then you'll stay safe. Um, but yeah, that's the basic idea behind tax loss harvesting. You're just harvesting the losses in order to offset any gains that you have. Now, I will tell you, I've seen people screw this up dramatically. We had one client, she was selling, or no, she was buying Amazon calls every month. And this was in 20, I don't know, 16 something. Amazon had a killer year. And so, she bought some calls. They went up over the course of the month. She sold them. She bought new calls that next month. Those went up. And so it kept compounding up and up and up. She made a huge gain for the year. And then she was rolling it every month into the next position. And so in the December position, she bought a whole bunch of calls and Amazon went down. And she basically lost all of her profits. But she lost all of her profits in the following year because it was a December, January issue. And so she ended up having to pay tax on the gains that she had already lost in January, which wasn't great. And of course, came to us in March and said, "Oh, this thing happened." It's like, well, you should have come to us in December. And
Right.
you know, uh, but this is part of the compass check problem. Compass check philosophy, why we do that now as opposed to just see us once a year back in those days. Um, so yeah, I mean, you got to make sure that you are on top of your positions and your calendar as far as making tax loss harvesting work because you can't go backwards. You can only go forwards if you have a capital loss. In the old days, you could go backwards, but they got rid of that.
Okay. So what's your thought on the Nvidia stock? Did you get some?
No,
What's your thoughts there?
I think I mean, I think AI is, going to be a huge, I mean, already is a huge thing, obviously, but will continue to be a huge thing and will continue to transform a lot of industries. However, I think it's the Nvidia stock in particular is way overbought. It's trading at like 200 times earnings, and I don't see those earnings sustaining into the future. I think, competitors will come in. I mean, they're already scheduled to, be releasing competition chips, and, Nvidia was definitely the first mover advantage, but I think their lead is going to run out over the next year or two, and then there will be, there'll be margin compression, and they'll have to compete more in the marketplace, and so their profits will go down, and their growth curve will flatten out compared to where it is now. But that's just my opinion.
Right.
Um,
It went to like what 1200 to 120, right? The split. I think it's 120 now.
I think it was a 10 to 1. I'm not sure.
Mm,
I
Crazy.
I've not actually tracked it.
Mm, No worries. So another question for you, and it's
Mhm.
about Roth conversions.
Okay.
So, what are the benefits and drawbacks of Roth conversions?
So a Roth conversion is when you have a traditional IRA and you want to convert it to a Roth IRA. So there's two different sets of rules. The In a traditional IRA, or it could be a 401k, it could be, whatever. Um, in a traditional plan, you put the money in, and in the year that you put the money in, you got a tax break. And then the deal is when you take the money out, you got to pay taxes at that point. So a Roth is the opposite, in that you don't get a tax break on the front end and you don't have to pay tax on the back end either. So, uh, so a lot of people like that about the Roth in that it's after tax money and that the growth is tax free. So, uh, but a Roth is not always available. And especially if you have like a 401k, you leave the job and then it rolls over to a traditional IRA, that kind of stuff happens a lot. So a Roth conversion strategy is to take advantage of low income years where you have this, let's say you have $50,000 in a traditional IRA, and for whatever reason that your income is going to be low for 5 years compared to where you normally are. So when you take money out of the IRA, it's taxable. But if you're in a lower tax situation compared to where you are normally, then it might be worth paying whatever that taxable bracket percentage is in order to get that money into a Roth that will then grow from that point on tax-free. So let's say you have $50,000, you spread it out over 5 years, you take $10,000 each year. And if you have low income years and you're in the 12% bracket, then you're going to pay, 1,200 bucks on that 10,000 in tax. So then 8,800 goes into the Roth and then grows from there tax free. And that trade-off might be worth it to you, if, for whatever your personal situation is, whatever your expectations are for tax rates into the future. And because that's really what you're doing. You're speculating that the tax hit I take now, and the opportunity cost of that is going to be less than the tax rate at which I will have to withdraw in the future during retirement. And that might be true. We have no way of knowing. Um, one thing that trips up a lot of people that I've seen over the years is people really, really do not understand inflation. So, when people say that financial planners will say a lot, it's like, oh, you don't have to worry about the tax rates, uh, on the traditional IRA because your income will be lower in retirement than it is now. Because, kids will be out of the house and house will be paid off and blah, 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 whatever reasoning they have. And it's like, maybe, so uh, one is inflation is real, meaning that nominal dollar amounts are going up. So what $100,000 pays for today is less than what $100,000 paid for 20 years ago, right? So because of that, the amounts that you're taking out in order to support any given lifestyle is going up in nominal terms. Okay. Now, will the tax brackets adjust for that? well, they do adjust every year, but they do not adjust exactly in relation to inflation. So this year there was I forget the percentage was because I did a whole thing on the math of it of how the increase in nominal terms of the brackets was, substantial. It was like 4% or something, but it way underpaced inflation. And when you factored in the fact that um, the income uh, the income amounts went up for the brackets and the deduction amounts went up for the brackets for like standard deductions, then the net change was actually like 1.2% rather than the 4% numbers. I know it's a confusing thing to try to follow, but basically, it is highly likely that the tax brackets will lag behind the inflation rate so that a given amount of lifestyle will actually go up in tax rate when everything is all assessed. So if you're living $100,000 lifestyle today, and in the in 20 years you're living a $150,000 lifestyle because of inflation, even though your lifestyle has remained the same, the tax you're going to pay on the 150 is likely going to be more than the tax you're paying today on the 100. So, you have to be very mindful of these kind of long-term impacts because, the thing about inflation is that inflation is a tax that everybody pays, and nobody has a bill for, so this is just purchasing power that is taken by the government by virtue of the fact that they, have the printing press. And I mean, there's more that goes into it, but that's the basic idea. So, you know, governments, or especially like first world governments, have gotten actually pretty good at managing inflation so that it is below the level at which people will riot. So, everybody knows like, oh yeah, things cost more and more every year, but it's not so much more that, it's, so dramatically changing my life that I'm willing to go out in the street and burn the place down. Um, so, I mean, last year was, I would say probably a notable exception to that in that we had like 10% inflation. But, by and large, the central banks so the monetary and the fiscal policy has done a reasonable job at eroding people's purchasing power slowly enough that they haven't wanted to tear the whole system down. And I personally I expect that to continue. So, you know, so so by converting from a traditional to a Roth, you are hopefully removing that speculation on tax rates that you're doing. And, you based on your numbers, is it worth the trade-off today in order to remove that possibility in the future? Now, with that said, the thing about retirement plans is that they are completely at the whim of the government. Congress could pass a bill tomorrow that changes all the rules on retirement plans. Say, oh, you put money in tax-free? No, now we're going to tax it. I mean, I don't think they will, but they could, right? Because these are just pure creations of the state. So, you know, there's a doomsday pessimist in me that says that at some point the federal government's going to turn around and take everybody's retirement money. And that is not without precedent. That has happened in other countries. Happened in Cyprus, it happened in Poland, where everybody, like in Poland, everybody woke up one morning and all their stocks and everything were replaced with government bonds, dollar for dollar, or I forget what their currency is. But so the government was able to say, it's like, hey, we didn't take anything because we gave you the exact same value that you had in your retirement account, and that was true. However, now it's you what they got was actually a loan to the government because that's what a bond is, and they gave up their stock ownership of whatever it is that they owned. But it was dollar for dollar. It's just that, whatever potential upside you thought you had in your stock is now gone because you're locked in at a, whatever 3% interest rate on your bond coupons. So, you know, these kind of shenanigans have happened, and I think they will continue to happen. Whether they will happen here or not is an open question. But as the currency gets weaker and weaker over the decades, then weird stuff happens, where the national debt's at like 34 trillion or something right now, and that's only going to go up. Um, there was a report out by the CBO a couple months ago at this point where they did a 10-year projection on the deficit, and they said that at no point over the next 10 years will the deficit be less than $1.5 trillion. And that's with the current legislation on the books. Each time Congress meets, they could pass additional spending if they wanted to, and oftentimes they do. So, you know, where will the dollar be in 20, 30 years? Whatever your IRA withdrawal time horizon is, who knows? So, it may be prudent to do one of those conversions if you have the capability to do it. Now, if you have hundreds of thousands of dollars in an IRA and you are still in a high income tax bracket, then there's very little incentive to do a conversion because you're going to be paying whatever your marginal bracket rate is. So if you're in the 35% bracket, you're going to pay 35% in order to avoid possibly a tax hit in 20 years. It's like, yeah, at that point, it's like, probably not worth doing. So yeah, yeah, but when you have random low years for whatever reason, then it can be really useful. I know that was kind of far afield as far as that one.
No, it's
Uh,
okay. Do we have time for one more or no?
we got 4 minutes, so if we got a quick one.
So it's a QBI question.
Okay.
So a client wants to know what is the process for a QBI income and if you can explain what that is.
Okay, so QBI, qualified business income, is a deduction that was created by the Tax Cut and Jobs Act. Basically, it created a deduction of up to 20% of your qualified business income. So if you have a pass-through company like an S corporation or a partnership where $100,000 is income to you, whatever your share is, that works out to be $100,000, you might get a deduction of $20,000 on that 100. So you're only paying tax on 80. So as far as how it's done, it's a tax form 8995, and there's 8995 straight, and there's 8995A. It depends on whether you're doing single or multiple, whether you're over or under thresholds. But it's a big math problem basically. And so um, there's two basic regimes where if you're underneath an income threshold, and that threshold depends on whether you're married filing joint or not. If you're married filing joint, I think this year's 384, 390, somewhere in there, 390,000. And if you are not married filing joint, so you're single, head of household, or married filing separate, then your threshold's going to be about 190. It's roughly half. And so if you're under that threshold, you get the flat 20% on your qualified business income, and that's the pass-through portion. So if you have an S corp and you take a W-2 and a distribution, it's only the distribution portion that gets qualified business income treatment. So that's something to consider. Um, and then uh, if you're over the threshold, then it becomes a test between 20% of the qualified business income and 50% of the wages, or 2.5% of the assets, like real estate and property and that kind of stuff, that the business owns. And whichever the 50% or 2.5%, whichever one of those is bigger, gets compared to the 20% of income, and whichever one of those is smaller, that's what gets applied to your qualified business income deduction. So there's a lot of optimization to be done. Normally when like if you have an S corporation, if you have a very profitable S corporation, um, the Social Security cap is what is the new number? 170, somewhere around there. After you exceed 170,000, then your Social Security tax stops. So it just remains flat. And then the only part that escalates is the Medicare portion of the payroll tax. And so, historically what happened is like, well, you don't want to pay more Medicare tax than you have to. That generally is not worth doing because you don't get any more Medicare credit or anything like that. But under the QBI system, it can be advantageous to actually increase your salary in order to optimize that relationship between 50% of wages and 20% of income. And it has taken me years and years in order to work out the math in a reliable way so that it applies to all situations. And that's actually what's in our templates, which I will go over in 1 minute. But as far as how you do it, you just fill out the form on the tax return, basically. So if you are interested in learning more, the best thing to do is go to taxsherpa.com/templates, and you can actually get our templates that we use, our master tax planning worksheets that we use internally with our clients. And inside of the templates, it's a huge Google Doc sheet, and inside of that, there are videos that go over each worksheet and how it all works. And along with that, you get our business base camp tax guide as far as like how the whole things works, how things fit together, how to use profit first and all that kind of stuff, as well as a tax filing checklist to avoid IRS red flags that will generate you nasty letters that you don't want to get from the IRS. And I've gotten them, so I can assure you, you don't want to get them. But yeah, you can get all that for $7. So not too steep, obviously. And we're working on making available our monthly navigator group again, where we get together every month and actually put those templates into practice. And there's actually a very specific sequence of events that we go through in order to maximize all those deductions and make sure you're not missing anything. So you can get all that at taxsherpa.com/templates. The monthly navigator thing is not live yet. We're still working on the back end tech stuff to get everything working. But once we do, we'll be sure to let you know. And with that, we will call it a week. Another week has passed, and we'll do it all again next time on the 18th.
Yep.
All right. So thanks everybody for hanging out with us, and we'll see you next time.
Alrighty.